Well, welcome back to Module 5 of our series on the Series 65 and 66 class. We're on page 6 of the outline, and we're starting to talk about the Investment Company Act of 1940. We already talked about what an investment company is, the different types. And now we have something that the 1940 Act defined, which is called a diversified management company. Now, a diversified management company really is kind of a badge that different investment companies can wear. All investment companies are going to have diversification, but in order to be called a, quote, diversified management company, you have to follow the 75-5-10 rule. And 75-5-10 rule is basically that of our portfolio, so here's our portfolio, with 75% of it, we have to follow certain guidelines, okay? Those guidelines include, let's go to the 5, that we have no more than 5% of our assets being put into any one company's stock, voting stock, okay? So basically there's the 75% of our portfolio, and with that 75%, no more than 5% can be put into one stock. Now, the 10 comes from the fact that you've got big investment companies, small target companies, or vice versa. So whichever one you hit first, it could be this 5%, or here's our target company over here that we're going to be investing in, and we can own no more than 10% of their voting stock, whichever comes first. So like I say, if you've got a big investment company, you're probably and a small capitalization stocks, you'll probably hit this first. If it's the other way around, then you'll probably hit the 5% first. But now here's the kicker, is that with this, we actually can do whatever we want to, okay? So that if we wanted to put 6% of our portfolio into a company's stock, we could do so. We'd have 5% here and 1% from that 25%. So we bought something and we bought it, put 3% of our portfolio in it 20 years ago, and now the thing has just exploded. Now all of a sudden it's 6-7%. We don't have to sell that extra 1% or 2% of our portfolio and take profits that we don't want to take because there's still more in it. Okay? We can actually take the surplus and put it up there in the 25%. So that's the 75-5-10 rule with diversified management companies. And like I said, no other restrictions on that 25%. So let's go ahead and move on to page 7. And basically what we're talking about here is prohibitions for management company. Management companies, investment companies that have to register cannot trade on margin. Now, you have to have a margin account where you can actually borrow from a broker-dealer in order to effect a short sale. So therefore, you can't do short sales in a registered investment company because you'd have to have a margin account. But you can't have a margin account, so the one precludes the other. An investment company can have bank debt if it's approved by the shareholders and if it stays within certain parameters that basically are not tested on this, but bank debt is okay. You can't have joint trading accounts. Now, we'll just pick on a big target, Fidelity. Fidelity has how many mutual funds? Oh my gosh, I have no idea. I can't count that high. How many of those mutual funds own Microsoft? Oh my gosh, I don't know. I probably can count that high, but I don't want to do the research to find out. But basically what you have is that Fidelity can't come in and say, we're going to make one purchase of Microsoft and then here you go, there's some for this fund and that fund and that. Okay, anybody else need some Microsoft? I got some. No, that's a joint trading account. This fund wants some Microsoft, they buy it. That fund wants some Microsoft, they buy it for their own account. Each management company is its own separate business, so it does its own separate trade. So joint trading accounts are prohibited, and more than a 3% interest in another investment company. There are certain that they're starting to loosen up on this, and so I wouldn't worry about that right now. But like I say, what you do is you wind up stacking management fees They're realizing that in certain circumstances it is a value added, so they're starting to change that a little bit. Like I said, I wouldn't worry too much about it because it gets way too deeply into the regulations for what you'll see on investment companies on this test. The composition of board of directors, though, very likely to see something like that. The majority of those must be outsiders, in other words, not associated with that investment company. And so a non-interested person, if I'm, since we started with Fidelity, then I'll just go ahead and pick on Fidelity and Putnam, okay? Again, not endorsing or making any type of qualitative statements. It's just the names you're familiar with. That's the only reason I'm using those. We don't endorse or talk badly about either one, about any company in this series. The companies we use just strictly anecdotal. But in any event, if I've got a Fidelity fund and there's an officer from Putnam, that Putnam officer is actually an outsider, a non-interested person over at Fidelity. And vice versa, the Fidelity officer could serve on the board of the Putnam fund and be considered a non-interested person. All right, and so a majority have to be the non-interested or outsiders, and the old rules had 40% that had to be outsiders. You may possibly see a question that has the old 40%. If you don't see majority, but you do see 40%, go with the flow. All we want is the right answer on a test question, and it's just a question they haven't revised. There's a good chance that they've taken those old 40%ers out, but just in case, be aware that those were old rules. Transactions with affiliates of the fund. Those are described in the allowable ones are described in the Investment Company Act of 1940. So buying or selling to and from the investment company is prohibited. So that if I'm one of the officers of the company and I have some stock that I want to buy from them, no. The thing is that's a business that is there for the benefit of the shareholders of the investment company. If I want to buy some XYZ, I just go out to a stock exchange or a NASDAQ and buy it. I don't buy it back and forth to and from the from the fund. Borrowing from the investment company, that's a huge no-no. I can't do that because I can't set up that investment company that it exists for the benefit of all these shareholders all across the country. I can't set that up as my personal bank, my own little petty cash fund. So I can't do that. I can't borrow from. I can't lend to it for that matter. And now the last line though, every good rule needs a good exception. And so the SEC can actually grant exemptive relief to allow for those affiliate transactions. If we can prove that this affiliate transaction is actually going to be in the benefit of the shareholders, then fine, on a one-time basis, the SEC can exempt this particular transaction. Like I said, that's about all you need to know about that, is that there is a little loophole. We have to apply for it. It's there. Sales charges. An investment company, of course, they don't have to, but they can charge sales charges. Breakpoints are given to quantity purchase discounts. These are available to any person, and a person can be a natural or a non-natural person. And so if I'm a retirement plan, yes. Now, what I'm going to do if I'm a retirement plan that's big enough, I'm going to go in and negotiate for some of their retirement plan shares, which are no load. But in any event, if I'm just a small company and I get enough business there, then I can get a break point on sales charges. They're available to any person, corporations, partnerships, etc. Holdings for minor children are aggregated, so my family is considered to be a single buyer. All right, so you've got that, and you can aggregate from other related accounts. So my purchases, my wife purchases, my minor child purchase, my retirement plan, her retirement plan, our joint account, both individual name accounts. All those can be aggregated to get those breakpoints in the sales charge. And we can in fact also use letters of intent and rights of accumulation to get those breakpoints in a sales charge. Letters of intent, that's where we don't have it today, but we'll have enough to get that breakpoint within 13 months. All right, or rights of accumulation. We don't want to put enough to get a breakpoint into this one fund. What we'd rather do is to have a large cap fund, a small cap fund, maybe a bond fund, maybe an emerging growth, maybe a foreign fund, 4 or 5 different funds, all in the same family. We can accumulate those in different funds, and also as it grows over time, if it grows to a break point, my next purchase is going to get the benefit of the break point. So those are all available to us. Now that's assuming that you have Class A shares, which we'll go into when we get in more into mutual funds. But I want to kind of give us a preview here of what we're going to see. Suitability is going to be one of the huge factors that we see going forward for an investment advisor representative and the investment advisory firm. Sales charges and the expenses of investing, those all come into play with regard to suitability. So if we have someone who's going to be investing a large amount of money, then that's one of the reasons of the availability of those breakpoints on the Class A shares. That's going to be one of the reasons why we want to go with the Class A shares to get the breakpoints. All right, and the real good probability of having a test question on that. We'll revisit that concept in more detail when we talk more about A, B, and C shares. So in any event, like I say, be aware that those sales charge breakpoints are available. We also can have no sales charge sales, or sales with no sales charge, even though it is an A share. In all probability, if you work for a broker-dealer and an investment advisory firm or one of the integrated services companies, then there's a real good chance that you're able to get funds that your broker-dealer has a selling agreement with at no sales charge. That's quite okay, as long as it's disclosed that, that those are allowable. So those are available to employees of the fund, employees of the advisor, the underwriter. They're extended on out many times to broker-dealers with whom there's a selling agreement, and then also contractual plan companies. Contractual plans they're still out there. To the best of my knowledge, they're not being sold. What I would do is I would just remember that contractual plan companies are one of the buyers that get no sales charge purchases. All right, it's a long story that's really not worth it. Much more efficient just to remember that term. The contractual plan company can buy A shares at no sales charge. 12B1 fees. This is an asset-based distribution fee. And 12B1 fees are allowed. They're reviewed quarterly, renewed annually. And let's see how we can remember that maybe, because we've got, we've got the review, and if I just misspell review, I got a Roman numeral 4 in here. I know it's cheesy, but 4 times a year I'm going to review. And then annually I'll renew a N-N-U-A-L or N-E-W, so both of those terms have an N in them. We'll renew those annually. There's initial approval by both the board and the shareholders, renewal approvals by the board only, and termination by the shareholders or a majority of the board. I want to kind of buzz through that because there's, again, just a little reminder that I can use when we talk about 12B1 fees and management or investment advisory contracts. The investment advisory contract for the management company, between it and the investment advisor, it must be in writing. And it's going to be that thick. Now, we'll revisit this. Remember that thing is going to detail absolutely, positively, every possible contingency that you've got between the investment company itself and the investment advisor. So that's going to be just huge amounts of detail that go into those contracts. It's going to detail all the provisions, including the compensation schedule, and because it is so detailed, it can go into kind of if-then situations that you don't have if an investment advisor is managing assets for just Fred or Bob or someone like that, okay? So we'll keep that in mind later on. Automatically terminated if it's assigned. Now, assigning means basically that I come to you and I say, hey, look, you're an investment advisor. I've got too much to do. Can I farm that out? I'll give you, 80% of my fee and just let you do it. No. They wanted me to manage that money. And so if I farm it out to someone else, then that's going to automatically terminate that contract, as it should. It could be terminated without penalty upon a maximum 60-day notice. I have really tried to figure out what the deal is with terminating a contract under a maximum 60-day notice. The only thing I can think of is that maybe it's kind of the son-in-law clause, that my daughter marries this guy that where's he going to find a job, and I give him a job managing one of the kind of obscure funds. Well, he just blows it. But I don't want my daughter to be out on the street, so I take 30, 40, 60, 90, 120, 4 years to get around to firing him, replacing him? No. Maximum 60 days notice that it can be terminated, that contract can be terminated. And it's approved initially by both the board and the shareholders. Then you have for a 2-year renewal period, and then the renewals are for a 1-year period by the board or the shareholders. Now, in case it comes up, let me just go ahead and give you a little reminder tool here, okay? And what we have is kind of new math, where 1 equals 2 and 2 equals 1. Well, what do you mean there, Dan? Okay. Let's just set up a little grid. And what we'll do is that we'll have initial, and then we'll have renew. We'll have 12B1 fees, and we'll have the investment advisory contract. So let's look back and see what we've got, okay? We have the 12B1 fees that, okay, let me get my notes here. 12B1 fees, and what did it say? Okay, it said that initial approval is by both the board and the shareholders. So initial approval, board and the shareholders. Okay? But the renewal is by the board only. So the number 1 time, the initial time, you need 2 parties to get that into place. The number 2 time, the renewal, it only takes 1 party. So let's look now over at the investment advisory contract. Let's see, it approved initially by both the board and the shareholders. There's the board and the shareholders. And let's look now on page 8. What is it? It's a 2-year term. So the number 1 time, that initial time, not only is it 2 parties, it's for 2 years. But then what about when we go to renew? The number 2 time that we have that in place. That's renewal by the board or the shareholders. Here you have and. Over here on the renewals you have or. And it's for a 1-year term. So 1 equals 2 and 2 equals 1. If it's the number 1 time, the initial time that we put those contracts in place, or that we put that 12B1 fee in place, then it requires 2 parties, and in the case of the contract it's 2 years. Okay? Then with the renewals, it's going to be 1 party and 1 year. So 1 equals 2 and 2 equals 1. Now, changes in investment policies. Okay? A shareholder vote is required for that. I had one fund that the tax laws changed, and in order to be in compliance with new tax codes, they had to change the objectives of the fund altogether, just go in a totally different direction. And so I tell you what, the wholesaler was in my office at least twice a week. Dan, have you contacted all of your shareholders? They really need that vote. Got to have that vote. because otherwise it would be punitive to the shareholders. So they really needed us to talk to those individual shareholders, get that vote. So a shareholder vote is going to be required for a change of investment objectives or a change in the structure of the company. Now, we talked last time about a unit investment trust. What I can do is that I can take a unit investment trust, and let's say that it's one that instead of bonds, we put stocks into it. And these stocks, they surprise us in two ways. First of all, it surprises us with how well they do. But the second way it surprises us, we thought that maybe it was going to take this long for that market to develop, but now it's obvious that there's even more kick in it if we go way on out further in time. But our structure now says that we need to liquidate this thing on that particular day. We want to extend it on out from there. You're going to require a shareholder vote for that. And in fact, if when we approach that point, it says, this thing could run forever, for crying out loud. We're in a new sea change. It's just totally different way of doing things. We could change that from a unit investment trust to an investment company, a management company, a mutual fund, maybe a closed-end fund. Closed-end funds, they're supply and demand for the fund itself drives the price. So if here's my net asset value, the price in the marketplace can float up above or down below that. Now, if it gets down too low, what I can do to give it an instant kick is to get my shareholders to convert it to an open-end fund or mutual fund, which always trades at the net asset value. So if I have that provision in there that we can do that, it kind of puts a tether on the downside. You know what? They might convert this thing and I'd miss out on all that, that bang. So like I say, we can change the structure, but it's going to require a shareholder vote. Shareholder votes are not required for change of investments. That's why we've got an investment advisor, a portfolio manager, is to make those day-to-day decisions. Should we sell this, buy that? Leave it up to the guy that we hired to do that. And then also portfolio distribution policies, because that's the job of the board of directors. So there's somebody who already does those things. We don't get to vote on those. As far as reports are concerned, we're going to report to for an investment company, we're going to report to the SEC. We're going to give audited financials annually and semi-annual filings. Now think back to just a regular corporation. A regular company is going to have those 10Qs quarterly, but a management company is going to report, an investment company is going to report, not just management companies, an investment company is going to report semi-annually and then audited again on an annual basis. To the shareholders, we'll provide those semi-annual reports that include balance sheets and income statements and portfolio holdings and changes in the period. So I tell you what, that wraps us up then on the Investment Company Act of 1940. There's so much that's in the Investment Advisors Act of 1940 that I really don't want to get into that in this module. I'd rather start clean and call this a natural breaking point. So let's go ahead and wrap up on this module, and then we'll come back after the break and we'll start talking about the Investment Advisors Act of 1940.